I think you're probably good to go, Dr. Koulianis.
Wonderful. Good evening, everyone. Thank you so much for joining us. This evening's program is Trends in Private Equity. Our speaker, who's graciously agreed to volunteer their time, is Howard Bogard, who leads the healthcare practice group at Burr Forman, and he brings extensive experience regarding the pros and cons of private equity investments in healthcare in general, and also in physician practices. As a side note, please hold your questions to the conclusion of the program and submit them through the chat sort of Q&A mode, and then we will address them at the end. The program will take about 40 to 45 minutes, which would allow us a solid 15 to 20 minutes for Q&A. So without further ado, Mr. Bogard, thank you so much for joining us and speaking to us on this critically important topic in healthcare today.
Thank you, Dr. Koulianis, and welcome everybody. It's great to be here this evening, talk about private equity and physician practices. A lot of activity in this area in the last, I would say 4 or 5 years in Alabama. And throughout this presentation, my goal is to explain a little bit about what private equity is, what are some of the issues, pros and cons when thinking about selling your medical practice to private equity, and then to talk about the process a little bit. So hopefully you're a little bit more educated if you decide to pursue this route. So let's start off first. And what is private equity? Kind of set the table here. So private equity is a firm that raises money from wealthy individuals, institutions, pension funds, and other sources. A lot of large universities invest in private equity. And the purpose is to buy private companies, especially in the physician context, to purchase physician practices. And the goal for a private equity firm is to achieve return on investment that is at least better or at least the same and preferably better than the market, than traditional investments. So they're looking at about a 20% annual return on their money. And so that's the goal for these private equity funds, because the investors in the private equity funds actually don't get their money back until there's a following sale. So the private equity firms typically hold a physician practice for about 3 to 7 years, 5 being sort of the average, before selling again. And that sale, and we're going to talk about some nomenclature here, the sale is called a liquidity event or a second bite. So that's when the private equity firm has acquired enough medical practices to get a critical mass, a certain return on their investment. They go back to market and sell again, sell that platform, their portfolio, to another private equity firm. So why healthcare? Because private equity is involved in lots of different industries, but private equity in healthcare is really is predominantly the main focus of private equity firms these days. And it's because healthcare accounts for so much of our gross domestic product, right under 20%. And healthcare is proven to be very resilient in terms of the economy, even throughout COVID. We saw actually record a number of private equity deals. And so private equity firms like healthcare. It's a growing industry, as you'll see on the slide. They also view that healthcare, especially the physician practice area, is fragmented, so it's ripe for consolidation. And we have an aging population, which just increases the number of, or the value of the healthcare portfolios that might be acquired. There's also this big shift that everybody's aware of from inpatient to outpatient care to ASC procedures. And so that benefits the physicians. And finally, there's some perceived administrative inefficiencies with physician practices. I don't know if that's exactly true, but the PE firms believe that if they consolidate multiple practices, they can achieve efficiencies in terms of HR, in terms of buying, in terms of compliance. And so some of those efficiencies are just achieved by economies of scale. So real quickly, a little bit about the volume of deals. Here's just some statistics. And I have a slide coming up that probably will illustrate this a little bit better. But through, in Alabama specifically for 2020, 2021, 2022, banner years in terms of deal volume. That's when things really took off. We're seeing a slowdown coming into 2023. But PE firms have a lot of money still waiting to be spent on acquisitions, and they have to spend that money. They don't make any money unless they buy a practice, can consolidate multiple practices, and then end up going to that next liquidity event or second bite. So we are seeing a little bit of an uptick as we go into the last of the third quarter and the fourth quarter of this year. And I think that trend will continue. Here's a chart that shows the PE deal count by year. You can see that 2021 was a huge year for private equity deals. And then in 2023, it's dropped. Now this number is through March 31 of this year. So it's just the first quarter. So we are seeing an uptick. But as I said, there's a lot of money still on the sidelines that these private equity firms have to spend. And we're seeing an increase just anecdotally with firms pitching private equity deals to physician practice clients of ours. So who does private equity focus on? Well, if you asked me 5 or 7 years ago, I would say dental, derm, and oncology were really the main driving specialties. But now it's just about every specialty that is the focus of private equity. And interestingly enough, primary care, family practice has attracted recent activity, and that's because of the value-based payments coming from Medicare. There's a PE play, if you will, on trying to consolidate primary care practices to increase the value-based payments from Medicare. And as you can see, the highest acquisition specialties as of recent were dermatology and in GI. So this slide, I apologize if it's a little fuzzy, but hopefully you can make it out. This is a slide that shows recent PE healthcare deals in the first quarter of 2023. The takeaway from this is in the second column and the last column. So the second column is category, and you can see that there's a wide variety of physician specialties that are represented: oncology, cardiology, musculoskeleton, which is orthopedics. We have ENT, we have primary care. And on the right is the exiting sponsor. And what that means is these are deals where this was the second or maybe even the third bite, where a PE firm has consolidated a portfolio of physician practices and sold to another PE firm. So the very top one, for example, is One Oncology. That's an oncology PE-backed focused platform. General Atlantic was the sponsor or the PE firm that sold to TPG, and AmerisourceBergen sold that platform, and they bought out, and now TPG will continue to presumably grow that platform and look for another buyer in 5 to 7 years. Here's just another slide, a continuation of the same thing. You'll see that there's a lot of different specialties represented, and some are second bite type of transactions, and some are just add-on type transactions. Okay, so let's dive into some of the details a little bit, some of the terminology. So the first practice that's purchased by a PE firm is typically referred to as the platform practice. This is typically a larger, successful practice dominant in the market. It sets the stage for future add-on acquisitions. And so the private equity firm is the whole goal is to add additional practices, typically in the same geographic market, but certainly in the same specialty, whether it's orthopedics or GI or ENT. they're going to add these other practices together. They're called roll-up or add-on practices. And the PE firm has a management services organization, or an MSO, that handles all the admin, the back office services for these acquired practices. And that'll make a little bit more sense when we look at a diagram later on. But that's how the PE firm actually makes its money. The money flows to the practice and then flows out to the PE-owned MSO, and that's how the MSO gets paid. But all the admin services are consolidated, again, to create economies of scale and hopefully reduce expenses. The private equity firms also, when they buy a practice, are looking to increase revenue. Now, contrary to what some people may think, private equity firms are looking for well-run, efficient, and profitable businesses. They're not looking for a turnaround type project, but they are interested in seeing if they can add, ancillary services to the practice, such as lab or pharmacy or imaging. They're also going to, try to pursue some value-based contracts, again, to, increase revenue, looking at mid-level implementation. And depending on the specialty, they look at ASC options. All of this is to increase revenue because ultimately, again, the PE firm wants to sell the platform in 5 to 7 years. And the more earnings that it can generate, the higher the return on investment. So let's talk about the deal terms, kind of the process, if you will. If you're approached by a PE firm, and I'm sure many of you listening may have been approached, the first thing that the PE firm does is gather up some financial information from you and to determine what a purchase price would be. And then they present that material back to the practice for consideration, and that is certainly subject to negotiation. If the parties generally agree on the purchase price, then the PE firm provides what's called a letter of intent to the practice. And that letter of intent details, what the definitive documents will look like. And we'll talk about some of those details in just a few minutes. And then as the process, if the letter of intent signed, you go move into the due diligence phase. The private equity firm is going to send the practice questions about the practice. They want to know about your employees. They want to know about your contracts. They want to know about any litigation, because they're buying the practice, and usually it's a substantial amount, so they want to make sure that there's no, hidden liabilities. You then negotiate all these key documents that we're going to talk about, and finally you close. From start to finish, and I mean from the time you sign the LOI, the letter of intent, to you close, typically the deal takes about 90 to 120 days. I have been involved in situations where we close a little bit faster than that, but that's pretty atypical. And I've had deals that it takes upwards of 6 months to close, depending on the complexity. So let's talk about the financial structure of the deal. So private equity firms value a practice based on what's called EBITDA. And it's earnings before interest, transaction expenses, depreciation, and adjustments. And it's basically a proxy for how much cash the practice generates after paying all the expenses, annual cash flow. And so the PE firm determines your EBITDA and then applies a multiple to it. And that's the purchase price. And the multiple is anywhere from 5 to 12. We have seen even higher multiples, although those are becoming less common these days, for really exceptional type practices, or maybe even a platform practice where the PE firm's willing to spend a little bit just to get into the market. And so the purchase price, whatever it is, let's say $10 million, pick a round number, is paid in a combination of cash and what's called rollover equity. And rollover equity is ownership, stock in the buyer, in the PE firm. And the reason for that is they want the physician's interest to be aligned with the private equity firm to promote growth. And at the second bite, that rollover equity, that let's just say was valued at $1,000 a share, hopefully sells for $3,000 or $4,000 a share, and the doctors receive the difference, the profit. Now, there's a lot of details that go into analyzing the financial aspects of a PE deal. And a lot of doctors will see that initial number and say, wow, that's a strong number. Maybe I'm interested. But you have to think about, all the certain deductions and various restrictions that go along with the cash and the rollover equity. Now, I've identified a few here, and we'll talk a little bit more detail in just a few minutes. But the cash is paid on the basis that there's no debt involved in the practice. So if the practice owes the bank money, it owes vendors money for equipment, all that has to be paid out ahead of time, and that comes off the cash purchase price. So in my example, we have a cash purchase price of $10 million. Typically, the split between cash and rollover equity is 70-30, 70% cash, 30% rollover equity, but it can vary. I've seen 80-20 deals as well. So let's just say it's a 70-30 deal, 7 million in cash. Out of that 7 million, you're going to have to pay off all the debt. There's going to be some holdback of that cash to cover what's called, it's an indemnity, an escrow, to cover liability that might arise after closing, but relates to a pre-closing liability. So a certain amount of money is put in this escrow. We'll talk a little bit more about that in a minute. Sometimes part of the purchase price is paid by a note, depending on or contingent on the practice meeting future revenue goals. We're starting to see, we didn't see a lot of that in 2020, 2021, but we're starting to see more of that where the PE firms become a little bit more risk adverse. So it's called an earnout. So you get your money as long as the practice hits certain revenue targets after closing. You're also required to leave a certain amount of cash in the bank, if you will, to cover 1 or 2 months operating expenses for the practice post-closing. That's referred to as net working capital. And finally, on the cash side, if the doctors leave typically before 5 years, there's sometimes a clawback of the cash. Because the PE firms, when they're buying the practice, what they're buying really is the revenue stream from the doctors continuing the work. So if the doctor leaves before 5 years, that's typically the target frame, the time period, then there could be a forfeiture of some of the cash. That's called a clawback. On the rollover equity side, as I mentioned, it helps align interest. It too is also subject to a clawback or a vesting if the doctor leaves before 5 years. And in certain circumstances, it can be forfeited if the doctor leaves even after 5 years. Just depends on the deal. And that stock, as I mentioned, is purchased upon a second bite. So the doctor has the opportunity to make some cash up front, get some stock, this rollover equity, and if there's another sale, that second bite, they'll get an additional round of purchase price based on the value of the stock as of the second bite. All right, so say you've gone through the financials and you decide to move forward. Well, we then have a letter of intent. Letter of intent is non-binding in most part. There are a few provisions such as what's called the standstill provision, meaning you can't negotiate with anybody else for a certain period of time. That would be an enforceable provision. But the PE firms will typically say, look, it's non-binding, just sign it and we'll figure it out, later, we'll keep talking. I don't recommend you do that. The letter of intent sets the tone for the deal. And if you agree to A, B, and C in the letter of intent, even though it's, quote, non-binding, the PE firm, if you try to negotiate that later on, will say, no, we're not going to revisit that. That was in the letter of intent. So it's worth spending some time really negotiating the letter of intent and not get kind of, sucked into, oh, it's non-binding, I'll just sign it and see where this goes. So in the letter of intent, you have the purchase price. We recommend we detail what the cash amount is and what the rollover equity is, and what is that split. We recommend you discuss the clawback provisions. How would you lose some of the cash? How would you lose some of the rollover equity? All these deals come with non-compete provisions, even though in Alabama, non-compete provisions, non-compete covenants, restrictive covenants of those sort, are not enforceable against physicians. They are in all these documents. And it's not, we don't recommend you just sort of ignore them. It's important to negotiate those non-compete provisions in the LOI as if they are enforceable, because the PE firm, if they want to, they could try to enforce that, and they have pretty deep pockets. So it's important to take those non-compete provisions seriously, even though in Alabama, it's somewhat questionable whether they're enforceable in all respects. It's also important to put in the document what the stock price is for the rollover equity. Is it $1,000 a share? Is it $1,500 a share? You talk about employment terms, and I mentioned the exclusivity or the standstill, as I refer to it, is binding. So that letter of intent is usually 3 or 4 pages long, and it's worth negotiating on the front end. So let's just say as we move down this continuum, you sign the letter of intent. The next stage is what's called due diligence. Private equity firms will conduct extensive and robust due diligence about really everything involving your practice. They're going to look at all your organizational documents, all your material contracts, licenses, permits, HR, tax matters, any litigation, any issues with your licensure or Medicare or Blue Cross. And they're going to start this right away by sending you a due diligence questionnaire. And that due diligence questionnaire can be 10 or even 15 pages long. And it's very detailed. And it takes a long time to respond to the due diligence. And they'll also bring in other parties. So that's just the legal due diligence. They'll bring in maybe an HR consultant to do HR due diligence. They'll bring in somebody to look at your medical charts to make sure that they've been coded and billed appropriately. They may bring in accountants to really dig into your financials and do what's called a quality of earnings analysis. So it's a rather robust, fairly intrusive, and not very fun process to go through due diligence, but it's important. And, there's really no way around it. And you have to, be pretty forthright and forthcoming with your responses. There'll also be regulatory calls or calls with lawyers and accountants and consultants about your due diligence responses. It typically lasts, the main time frame for due diligence is in the first 30 to 40 days after the letter of intent is signed. But it'll continue throughout the process. They'll continue to follow up with questions. You sent this agreement, but it's missing a certain page, or explain this liability. So it's an ongoing process, and it takes more than one person. So it's very important to have people within your practice that can adequately spend time responding to this while also doing their day job. So it does take several folks internally, and the lawyers and accountants can help as well. All right, so let's talk about the purchase agreement. So we've gotten through, the LOI, we've gotten through due diligence, or that's ongoing. We're now to the point where we're starting to get documents. So the first one is the purchase agreement. That's where they buy your medical practice. And as I mentioned, the purchase price, the cash price, has several deductions from it that we have to consider. And those are, you got to pay outstanding debt. You got to pay the transaction expenses, lawyer fees, accounting fees. Off of the purchase price is the rollover equity. So in my example, the purchase price is 10 million, but the rollover was 3 million. So we got 7 million in cash to deal with. We got to pay out PTO. We got to deal with credit balances. We are going to have to put something in the escrow for these indemnities that we're going to talk about in a minute. And of course, you have to figure out the tax implications. It is common that we can structure these arrangements so that most, but not all, of the cash proceeds are taxed as long-term capital gains. So that's beneficial. Some will be ordinary income depending on the assets, and we work very hard to get that amount as small as possible. But some amount of the purchase price, the cash purchase price, will be ordinary income. The rollover equity, good news is tax deferred. So you don't pay tax on that $3 million until it's sold. And at that point, you pay tax on the profit. The escrow I mentioned is typically 5% to 10% of the purchase price. And what that is the seller wants to make, the buyer wants to make sure that if there's a post-closing liability that arises, that goes back to the seller, to the doctor. So for example, say you have a deal that closes August 1. And after closing, 6 months later, a HIPAA issue is discovered. And that HIPAA issue occurred in January of this year. So while, before the sale, before the closing, the buyer is going to say, okay, doctors, that's on you. That happened prior to closing. That happened on your watch. You're responsible. And say it's a $100,000 liability. Well, if the practice has to pay that money, the buyer is going to dip into this escrow and pull out $100,000. So the escrow is just available money that the buyer can use to cover these liabilities that might arise that occurred pre-closing. And these escrow amounts are negotiated, and they come back to the practice somewhere between 12 to 24 months after. Sometimes they're tiered. Half comes back after 12 months, the other half after 18 or 24 months. So that's all negotiable. But that's money that you'll get, provided there's no indemnity claim. But it's a deduction from the cash at closing. You also have something called net working capital that I mentioned. So they're going to want a certain amount of money left in the account, whether it's in cash or your accounts receivable. And then there's a true up about 90 days, maybe 120 days after closing. So for example, if the buyer says, we want you to leave $150,000 in cash in the bank account or an AR that we collect after closing. Well, if the amount of cash is $130,000, we're $20,000 short, and that $20,000 will be pulled out of the escrow. If the cash, however, is $170,000, so we're more, we're $20,000 above the target of $150,000, then the buyer pays the seller, the practice, the additional $20,000. So that's another factor that just has to be accounted for when determining the true value of the arrangement. All right, in the purchase agreement, there's going to be what's called a lot of reps and warranties. These are statements by the practice and its physician owners to the buyer that there's no issues with the practice, that we paid all of our taxes. We don't have any litigation. There's no issues with Blue Cross or Medicare. We haven't received any EOC complaints. To the extent we have any of those things, we just list them out on a schedule. And in this context, it's better to be overly inclusive than under. So we don't want to really hide anything here. It's better for the practice, the selling physicians, to disclose any of these issues. And so this is a process that we go through with the clients to go through these reps and warranties and find out, is that something we can say? And if not, we tell the buyer, hey, we did have an EOC claim. We did have, one of our doctors did have an issue with his license, and we disclose it so the buyer's aware of it. So I mentioned non-competes. There's actually going to be 3 non-competes that come up in these deals. One is tied to the purchase agreement. One is tied to your employment agreement. And the third one is tied to the rollover equity. A lot of time the PE firms will talk about the first 2, but not the third. And you find that out kind of through the process that there's a non-compete tied to the rollover equity. That one's very important as well. So you have to look at all 3. So the purchase agreement non-compete typically lasts for 3 to 5 years after closing and says that, doctor, if you leave the practice, you cannot compete within 20 to 50 miles typically of your office until the end of that 3 or 5 year term. So let's just say it's 5 years. At the end of 5 years after closing, this non-compete goes away, it sunsets. But if you leave after year 2, you have 3 more years under this non-compete. There's also a lot of other restrictive covenants. Non-solicitation provisions are one example. So when you leave, you can't solicit patients, employees, referral sources. You can't hire people from the practice, and you can't use the confidential information of the practice. So there's a lot of provisions that protect the practice. And from the PE's perspective, the doctors are really the only people generating revenue. That's what they're buying. So if a doctor leaves, they don't want the doctor going across the street and pulling his or her business with them, because that hurts the revenue of the acquired practice. And if you also think about it, as the doctors who sold the practice, you're now, owners in the PE firm because you have that rollover equity. You want the value of the practice to grow. So if you put on your employer hat, if you're the physician staying, you really don't want the doctor leaving to compete as well. So it depends on which hat you're wearing. As an owner of the practice, you kind of like these non-competes because it preserves the value of the practice, which enhances the revenue, which creates more value for the platform, which hopefully gets a higher purchase price at that second bite, which makes you more money on your rollover equity. If, however, you're the doctor leaving, you don't like these so much. So it's, there's a back and forth and a fine line we take when we negotiate these sorts of provisions. In the purchase agreement, we also have indemnity provisions. And so we mentioned this, so I won't spend but a second on it, but these are typically the money that's put into escrow. I mentioned 5 to 10% of the purchase price to pay for pre-closing liabilities. But some of the indemnity obligations extend even after the escrow goes away. So for example, if there's a tax problem or there's a problem with Medicare, those sorts of issues, those indemnity obligations typically exist for 6 years after closing. So even though the escrow has gone away, if 4 years after closing, Medicare comes and says, hey, you owe us $100,000 from something that happened prior, for dates of service prior to closing, the buyer's going to say, when they take that money out of our account and recoup it, doctors, you're on the hook. And that liability would be personal to each doctor who's an owner, who was an owner of the practice, who sold it. So these indemnity provisions are highly negotiated. Obviously, as a lawyer for the selling practice, we want to limit these as much as possible. We want to put caps on them, dollar caps to say no more than X dollars. We want to put what's called deductibles, saying, look, you can make a claim for indemnity, buyer, but only if it hits a certain target, $50,000. So those are important because they create liability for the physicians. Okay, so let's move on to the PEA, the Physician Employment Agreement. So every doctor will sign a new employment agreement as part of the closing. Compensation is paid on typically collections. So it's not RVUs like you would see in like a hospital employment arrangement. We also see sometimes ancillary profit pools, overall profit pools. If the practice hits certain targets, everybody gets paid a little bit more. You can get paid for mid-level supervision, research. There's a lot of different, variables, but typically it's collections. It's not collection less expenses. It's just a percentage of personally performed collections. Now, the important thing here is you're not going to be paid the same amount as you made pre-closing, because the PE firm's got to make some money on this deal. They got to have some revenue. So usually there's a 20 to 30% reduction in compensation starting out. Sometimes that's called a scrape. PE firms don't like that term because it's somewhat derogatory, but it's a reduction in your comp. So if you made, $300,000 a year in compensation, and there's a 20% scrape, you're going to make, $60,000 less. Now, I mentioned that PE firms like to introduce ancillaries, labs, therapy, DME, imaging. And so to the extent, and then put mid-levels in, to the extent you don't have that in your practice, they may put those ancillaries in there and try to do what they call income repair. Whether it's successful is debatable. I've seen it work, I've seen it not work. But the thought process, and the PE firms will tell you this, is, hey, we're going to introduce these other revenue sources, and that will reduce the scrape. You'll get paid on these additional ancillaries, and you'll have this, quote, income repair. I think you have to go into it not counting on that. When you look at, is this a good deal? You look at the cash up front, you look at the rollover potential, you look at your salary, and do you think you'll be better over the next 5 years? We also have, termination provisions with or without cause, and automatic termination provisions, loss of license, Medicare issues. All those are fairly highly negotiated terms, because if you leave employment or you're terminated, your employment's terminated, a lot of times that creates a clawback of the cash or rollover. So we want to make those as protective of the doctors as possible. So I mentioned this, that there's a clawback potentially if you leave before 5 years. Sometimes it's tiered, if you leave before 5 years, all the rollover comes back, or a certain amount of the cash, it's all negotiable. But there is a stick. You can't just take the money, take the rollover, and stop working and go somewhere else. And we do have restrictive covenants, as I mentioned. They're similar to what was in the purchase agreement. These are typically while employed and 1 to 2 years after. Okay, so the final document, the key document, and there's a lot of documents that we haven't talked about, but these are the main three, are MSO agreement, the management services agreement. So typically in a PE deal, all the non-clinical people within your practice, the receptionists, the techs, anybody really without a license. So we're talking about everybody other than doctors and APPs. Everybody else goes to the MSO. The administrators, everybody goes to the MSO. The only people left in the practice as employees are the doctors and the APPs. And the MSO provides all the back office support, the HR and compliance, billing, collection, IT, essentially everything. And the money comes into the practice and goes out to the MSO, and the MSO pays all the expenses and then gets its management fee. And the management fee is that scrape. So the 20 to 30% that the doctors are, reducing their comp, that 20 to 30% is the management fee that goes to the MSO, which is really the PE firm's return on investment. It's very important when negotiating the MSO agreement that for the doctor's perspective, we try to maintain as much clinical autonomy as possible. There's a lot of, studies and people talking about, is PE good for medicine? And I'll leave that up to everybody. Does PE firm interfere with clinical independence? Does it limit care? Again, more of an ethical, philosophical debate. But one of the things that's important from the seller's perspective is to put in place, sometimes it's called a clinical governance board, but it's a physician entity that makes decisions about clinical issues. Physicians to hire and fire, vendors to use, best practices, medication management, things that are clinical in nature. It's important that these documents allow those decisions to be made by the physicians without interference from the PE firm. And I will tell you, after doing a bunch of deals, the good PE firms, if you quote good, are the ones that sort of get out of the way and let the practice continue to do what it's been doing because they're well-run, profitable practices. And so they try not to interfere too much with the day-to-day operations. They try not to, cut a lot of staff to hopefully reduce expenses. I say that's the quote good ones. There are PE firms that kind of get more involved in the day-to-day operations. And so when you look at these deals, along with looking at the purchase price and the rollover equity, you got to make sure it's a good fit. Philosophically, the way you want to run your practice seems to fit with how the PE firm wants to run your practice. So this is the structure. It's very simplified, but this is how it looks. So after closing, the physician practice is owned typically by all of the owners. They're called friendly owners because they're owning the practice, but they don't really make a lot of decisions like they used to, and they don't get distributions. And typically that is either all the owner physicians or one or two just continue to own the practice. Everybody else is employed by the practice as physician employees. The MSO contracts to provide non-clinical services, the admin services to the physician practice. And there's the percentage of revenue that goes back. That's the MSO fee. Excuse me. And up at the top, you have the buyer, which is owned by the PE sponsor, the PE firm, and the physicians with rollover equity. All right. So finally, pros and cons. And this is not an exclusive list by any means. So what are the pros? Well, you get to monetize your practice. So when a doctor leaves a typical private practice, he or she may get some money for the stock, but typically not a lot, will typically get some percentage of his or her accounts receivable, and that's it. So there's not this big buyout for the medical practice, for the doctor who's leaving. Here in a PE deal, there's millions of dollars, purchase price is millions of dollars, and it's obviously divided up between all the owners. But it's a way to monetize the practice. And that's why a lot of times PE deals are more attractive to physicians who are 5 to 10 years away from retirement versus a new doctor coming in that is, 30 years away, if not more, from retirement. They're probably may not be as enticed by the private equity model, where the doctors who are looking at leaving soon are comparing what they would get if they just left from a private practice as compared to what they can monetize the practice for in a PE sale. PE companies also could provide access to capital. I've had practices that say, look, we need to upgrade our EMR, our computer systems. We want to buy an MRI or other piece of major medical equipment. And that's a risk for the practice. A lot of times the PE company will come in and incur that cost. And if that's a big factor in the sale, I recommend that that's addressed upfront in the letter of intent. You may get more favorable vendor pricing. Again, economies of scale, high caliber management team. I put a question mark by that. This MSO typically is started off by the platform practice. So you may be able to, get some high quality people. Most of the time you have more resources. You have a CEO, a CFO, a COO, an HR director, maybe people responsible for those items, where in your private practice, you just don't have the volume to support those types of folks. So, typically there is more management resources after the PE deal closes. Assist with physician recruiting, another question mark. Physicians coming out of med school and fellowship may or may not like private equity, but private equity can offer them some stock, some ownership, so some upside to join the practice. And a lot of times they're willing to provide some good sign-on bonuses, maybe more than what a private practice, if the doctors are doing it out of their own pocket, are willing to do. Assist with compliance issues. I mentioned, that all goes back to the MSO. I talked about, attracted the physicians nearing retirement. And it is built for this exit, the liquidity event. The private equity firms, they're not there to buy and hold. They're there to buy add-on practices, grow the platform as quickly as possible, and sell it to the next private equity firm. And as a doctor who owns private equity, you kind of like getting to that second and third bite as soon as possible because you're going to make profit on each sale. Now, on the cons, you do have some loss of control and culture. That's where making sure it's the right fit becomes very important. Because you have, whoever holds the money makes the decisions. And so the PE firm is going to be at the table making decisions. The doctors may say, look, we want a new MRI. And the private equity firm may say, look, we just don't see the return on that investment being worth, buying an MRI for $1 million. So there can be some clashes there. We talked about reduced compensation. That's the scrape. Impact on patient care, again, a big issue. We have restrictive covenants we talked about. There's a clawback. So, going into these deals, you really have to think about it's at least a 5-year commitment. Otherwise, you're going to be subject to some of these clawbacks. And I mentioned may not be as entirely attractive to the younger physicians. So with that in mind, I will stop sharing my screen and I can open it up for questions.
We have one question already in the Q&A, and that is, do physicians typically earn periodic dividends from the equity they acquire through a buyout, or is it only useful for a later buyout?
Yeah, so good question. So typically there's no distributions while you hold your equity, your rollover equity. Now, sometimes that rollover equity will accumulate interest, sort of like a bond, if you will, but that's only paid out at the second bite. So in somewhat simple terms, if you get your rollover equity at $1,000 a share, you have 10 shares, so it's worth $10,000. You just hold it, and there's really no value to you until the second bite. And hopefully the second bite is at $3,000 or $4,000 a share. So there's no distributions, there's no dividends that are distributed. I will say, though, as a caveat to that, if you leave, and as long as it's not a forfeiture event, you're not terminated for cause, many times the equity will be repurchased at that $1,000 a share. So you'll at least get your money back, but you won't make any profit off of it. But otherwise, there are no annual distributions or dividends that come from the rollover equity.
Very good, thank you. I have a question. In terms of costs to patients, do equity capital owned practices tend to have higher fees for patients, the same or lower?
Yeah, so as you know, and others, your charge sheet, whatever you charge, is somewhat irrelevant except for a cash pay patient, because you could submit a claim for $1,000 for an office visit, and Medicare Blue Cross is going to pay their fee schedule. Now for self-pay patients and maybe for workers' comp, that your fee schedule may become more relevant. I have not seen where PE firms go in and raise the fee schedule. Typically a private practice wants to have a high enough fee schedule so they can take advantage of maybe, workers' comp, maybe out-of-network payers that pay charges. So typically the charge sheet, the charge master is pretty, pretty strong to begin with. But I have not seen PE firm, go in and try to raise that. Not to say it hadn't happened, but it just hasn't come to my attention.
Yeah, I just looked at a paper from the British Medical Journal that looked at several parameters in private equity. And one of the things that they showed is in 3/4 of the studies that they reviewed, cost to patients actually went up.
Is that based on the US insurance system or?
Yes.
Okay. Did they say why the cost went up?
No, it's just sort of a summary paper I looked at this
Yeah.
morning.
You know, I guess, and I'm just kind of, speculating here. I don't know necessarily if the fees go up, but, could there be increased pressure to maybe order more ancillaries to make up for that scrape? Maybe the PE firm, wants to hit certain revenue targets, so there's more pressure. I could see that happening. More metrics that say, look, let's keep more in-house, let's not refer out, let's capture more of those ancillaries. So, and that goes into, are they interfering with clinical decision-making? So I'd be interested to look at that, but I could see where that happens. I just haven't seen it on the fee schedule side.
Okay. Do we have any other questions? I really don't see any others. I can't thank you enough, Howard, for taking the time to be with us today and to really enlighten us. I think this was a wonderful summary. I wish I had this before I started negotiating with Equity Capital many years ago, because it would really have made the process far more understandable. It'd be great if we could have some kind of toolkit, for physicians to be able to go on the MASA website to just draw on that, we could use, in partnership with Burr Foreman. I think that would be outstanding. My other question is regarding young physicians, do they end up having the same, overall, is it a net positive or net negative for a young physician to come into an Equity Capital owned practice?
Yeah, that's a really good question. I think it depends. If it's a young physician that's an owner that's going to participate in the sale proceeds, there's probably a fair amount of upside if the PE firm, the platform goes through, a second, third, and fourth bite. And that's a big if. But they're getting their cash up at the, at closing. And they, given that they're going to be working for a long time, they may enjoy the second and third bite profits that come from those sales. I think it's a much harder question about a new doctor that you're recruiting into your office, your practice, that didn't participate in the sale, so got none of the purchase price. And the incentives are, we'll give you a signing bonus, we'll give you some equity, but it's limited. So I think it's a little bit of a harder analysis and probably more risk for a new doctor coming into a PE-owned firm. And that's why on the slide, I said, help with physician recruitment, I put a question mark, because in some of the PE-backed, private practices that I've represented and sold, they've come to me and said, yeah, we're having trouble recruiting. Not all, but some, because one, maybe new doctors don't want to work for private equity. And second, they're like, okay, there's really not a partnership anymore. I can't be an owner anymore because the practice has been sold. What's my upside? And it's just not as much. So that's a real challenge. And that's why they're giving a lot of equity to these new doctors to say, look, if you stay with us through the second bite, you're gonna participate in the sale. And that's where the benefit's going to come from joining this PE-owned firm.
So with the MSO really managing the practice, and with, in some ways, income's going down, do you think that the sort of MSO changes that occur in an Equity Capital practice impact physician autonomy?
I mean, without a doubt, there's going to be some loss of control. And, that is, you can negotiate that, but, a contract only only goes so far. So that's why you got to make sure it's a good fit. But yeah, absolutely. There's going to be, I mean, right now, a doctor and a physician practice, say there's 5 owners. Those 5 owners get together, probably informally, make decisions. They want to hire somebody, they want to buy something. It's usually a pretty informal process. Maybe if it's a big, purchase, they run numbers and look at it from, return on investment. In a PE-owned practice, you can't hire and fire non-clinical people as easily. You got to go through the PE firm. You can't buy stuff as easily. You got to go through the PE firm. And so everything, has that level of oversight, especially if it involves additional capital, additional operating costs. And so it's a loss of control. Absolutely. And that's just, it's just part of the deal. So hopefully you can negotiate on the clinical side a lot more autonomy, but on the non-clinical admin side, the PE firm is definitely at the table, and they have a veto right over certain things. So and that's really, honestly, that's the biggest issue I see with practices that have sold. It's the changing culture, the loss of control. And that's why it's so important to make sure you got a right fit, talk to other practices that have, under the PE platform already, talk to people who have left, maybe more importantly. Why did you leave? Was it well run? Was the PE firm, involved day to day, or were they very hands off? What's the culture like? So, you got to do your due diligence ahead of time. It's not all about the money.
Very good. Well, the hour is getting late, and we've taken a lot of your time, and I can't thank you enough for today's program and the insights you've provided us on behalf of all of our physicians here in Alabama and our participants today. Thank you very, very much.
My pleasure.